Hello everybody, this is Lara with your weekly video for the S&P 500 for the week ending Friday 17th of March 2023. Thank you so much for your patience in waiting for your analysis for Saturday morning. I was not able to get it done on Friday evening this week. This week it really does look like prices affecting another test of support about the upper edge of the bear market channel. It's really typical behaviour after a breach of support and resistance, to have a back test of where that area was before price moves away from that area. And so this supports the main Elliott wave count. If next week price moves back within that bear market channel with a full daily red candlestick downward movement back inside the channel, fully inside and not touching the upper edge, then the wave counts would be swapped over. That's what I need to see for the analysis to switch from bullish to bearish. The main Elliott wave count expects upward movement, and the final target for primary wave 3 is 7742. If we see a new high above August last year, 2022, 4325.28, that would add substantial confidence to the main Elliott wave count. At that point, I would discard a bearish alternate. On the weekly chart, this is the main Elliott wave count. It sees a primary degree first wave over here, within a cycle degree fifth wave. Cycle 5 subdividing as an impulse will be labelled at primary degree 1, 2, 3, 4, 5. Primary 3 will reach 1.618, the length of primary 1, at 7742. That's a reasonable target because it's a fairly common Fibonacci ratio between a first and second wave for the S&P 500. Primary 3 may only subdivide as an impulse, and within it, intermediate wave 1 looks incomplete. When intermediate wave 1 is complete, then a multi-week pullback or consolidation for intermediate 2 will then be expected, which may not move beyond the start of 1, but that's a fair ways away yet. Intermediate wave 1 subdividing as an impulse with minor waves 1 and 2 complete, most likely minor 3 subdividing as an impulse with minute 1 and 2 complete, and now minute 3 within minor wave 3 may continue upward beginning next week to show an increase in momentum and should have support from volume. Along the way up, if we see a new high above this prior major swing high within the bear market, this is August 2022 at 4325.28, then the series of lower highs and lower lows would be broken, and that would add substantial confidence to a bullish wave count. Small and mid caps have made new highs above this point. The NYSE Lowry's operating companies only AD line have also made new highs above this point, which would tend to suggest that the S&P 500 price will eventually follow. So that's all rather bullish. There's more technical evidence for a bullish case than there is for a bearish case. That's why this is the main wave count. Within minor wave 3, minute wave 2 may not move beyond the start of 1, below 3764.49. However, it is possible now that minor 2 could continue further sideways and a little bit lower. It may not move beyond the start of minor wave 1. It looks like minute 2 should be over here though. Let's take a look at the daily chart. The high of minor wave 1 up here is this point up here. Here's minor 2, a brief zigzag. Minor wave 3 beginning as an impulse with 1, 2, now 3, 4, 5 to continue. The target the same as at the daily chart level. I've copied the bear market trend line from the weekly chart over to the daily chart. There is no full candlestick below and not touching this line. Price has not moved back into this line. As price approached the line, it found resistance, moved down and away, approaches the line again, around about the line, not perfectly. Resistance again, moves down and away, breaks through, closes above, and finds support for a back test here, moves up and away, coming back down for a deep test of support. This is really typical behaviour of price after it breaches a trend line. Now, just quickly back to the weekly chart, because this trend line is sloping, it is possible now that minor 2, maybe it wasn't over here, it could continue lower, and price may remain or it may not break back into the trend line, and yet we could see a new low below 3764.49. That is possible next week. If it starts to look like that's going to happen, then that will be an alternate daily chart for me. But for now, it looks most likely that minor 2 is over here, minor 3 has begun with 1 and 2 complete, and 3 to begin higher next week. The risk is quite close by at 3764.49. At the weekly chart level, this is if we move the degree within the zigzag down 1 degree, primary 2 may not have been over there. That might have only been the first zigzag in a double zigzag for primary 2. Double zigzags are pretty common Elliott wave structures, and this could explain the breach of the bear market channel. The bear market channel contains intermediate W. Intermediate X could breach that channel, and yet the structure for primary 2 could continue lower, with a second zigzag for intermediate Y now unfolding, to be labelled A, B, C, and within the zigzag, B may not move beyond the start of A, above 4195.44. I would probably discard the wave count if we see a new high above the invalidation point. To the downside now, if we see a new low below 3764.49, we could have a bit of confidence, although as I explained on the weekly and daily chart for the bullish count, if we see a new low below this point, now, because the sloping trend line is moving lower, that could be minor 2 moving lower and taking up more time, and then it would actually have better proportion. So this confidence point is now no longer as strong as it was last week, just so you know. The zigzag for intermediate wave Y should take several weeks, if not months, and the purpose of the second zigzag in a double is to deepen the correction when the first zigzag doesn't move price deep enough, so the target at 3195 would see that achieved. Let's take a look at the daily chart. The high of intermediate X here, this point here, the start of intermediate wave Y, A, B, C, minor A subdividing as an impulse with 1, 2, 1, 2. An increase in downward momentum is expected for this wave count next week. On the weekly chart, here is the bear market trend line. It's drawn from the all-time high, sitting across these two highs quite nicely, perfectly tested here, a little overshoot here. Test, move down and away, breakthrough, test of support, and a deeper test of support, slightly moving within the line, but we don't have full daily candlesticks of downward movement below this line. It's still around about where this line is providing support. This week was an upward week, more upward movement than downward within the week. It's not a piercing pattern though, because this candlestick hasn't closed halfway within the body of the previous candlestick. There is a volume spike this week. We really do need to look inside the week to tell whether it's upward or downward volume. And this volume spike includes Friday's options expiry date. So we can't read too much into that. There's always a spike of volume on options expiry date. Resistance holding about 3950, support below quite strong, about 3600. On balance volume gives no signal. It's got an increasingly technically significant range though. The resistance line has 4 tests. The support line has let's see, 3, 4, about 6 tests. This support line has strong technical significance now. It's at a higher time frame, it's close to horizontal, it's long held, it's got multiple tests. A break below support would probably see the bearish wave count become more likely. A break below above resistance would add confidence to the bullish count. ADX is too low, it's below 15 now, too low to indicate a trend. Might be slightly inclining. If it reaches 15 and it turns up, that would give a strong bearish signal, but this week there is no bearish signal. 15 is the cutoff point to weed out false signals. You have to have a cutoff point somewhere, and I think I got that one from Kirkpatrick and Dahlquist. 15 looks like a pretty good cutoff point. RSI neutral, money flow neutral, stochastics returning from overbought to neutral, price moving down from resistance towards support, a model using resistance and support with stochastics to tell us when one swing ends and the next begins would tell us to expect downward movement to support about 3600. But the last test of support down here didn't reach 3600, it only reached midway and didn't quite touch midway within stochastics. It remains to be seen if that model works for the current situation, but that's what it says. The model says downward movement until stochastics reaches oversold and price reaches support. ATR declining as price moves higher and now essentially flattening off, normal behaviour for this market. On the daily chart, Friday was an inside session with mostly downward volume to complete a red real body for this candlestick. Options expiry, a spike in volume for downward movement within the session, but it hasn't made a lower low. It's just an inside session, so I don't think we can read too much bearishness into that. Resistance holding 3950, support next below 3850. At the daily chart level, ADX is also declining. There's no clear trend at either time frame. So stochastics at the daily chart level reached oversold. Price reached support about 3850. Stochastics moving back into neutral. At the daily chart level, using the model of stochastics with support and resistance, we should be expecting overall upward movement to resistance about 4,000 or about 4,050 or about 4,175. Expect overall upward movement to continue and until stochastics reaches overbought. But again, this model is not working perfectly for the situation at this time. Essentially, price is range bound. There's resistance about 4,175, support about 3,720, a little bit below, and price is swinging from resistance to support. We need to see a breakout before we can really have confidence of the direction of the next trend for price. On balance, volume would suggest it could be downward. It's giving some bearish signals, not the strongest bearish signals, but there are bearish signals here. We've been over ADX. RSI and money flow both neutral, and ATR increasing as price was rising for some upward sessions this week, and volume remaining heavy on upward sessions above the 50 period moving average for volume. So that would tend to support the bullish Elliott wave count. And I do still have all of these points, and I check them each day of publication, all of these points for and against the bullish wave count. They still remain valid. This week, prices moved lower with a lower low and a lower high. The AD line has declined. There is no new divergence. There was a tiny cluster here of bullish divergence that could be resolved. At the weekly chart level, there is no unresolved divergence, either bullish or bearish. The AD line is moving pretty much in tandem with price, not giving us a signal at this time frame. At the daily chart level, this bullish divergence was resolved here, so we can ignore that now. It's been resolved. Here we have a very small weak cluster of bearish divergence developing between price and breadth. For Friday, price has made a higher low on a closing basis. The AD line has made a lower low. This divergence is bearish. Where breadth leads, price usually follows. So there's a little cluster of very short-term bearish divergence. Again, when I told you on the weekly and daily chart, the main Elliott wave count, that minor 2 could continue a little bit lower, this would tend to offer just a little bit of support for that possibility. So that's the risk for the bullish wave count at the moment. At the monthly chart level, there's still this extremely long-term bearish divergence between price and the Nasdaq AD line. Nasdaq's making new lows below March 2020 over 2009, not 2020, and also 2020, the COVID low back down here. It's made new lows below that. Price has not. This bearish divergence is very long-term. It's been in existence for years now. And yet the bull market for the S&P 500 continued, so obviously it's hopeless in terms of timing. Eventually, when the bull market, the secular bull market ends and a huge bear market arrives, then this divergence may eventually be resolved, but it's hopeless for timing. We can't tell when that's going to happen. It could continue for years yet and set up even further. At the weekly chart level, the Nasdaq AD line is essentially even with this low back here. Price is a little bit higher. It's not enough really to say that there's clear divergence. Nasdaq has made new lows below the COVID low of March 2020. Price has not. There is mid, long, and very long-term bearish divergence here. Between price and volatility, this week both have moved lower. Inverted VIX has moved lower, price has moved lower, no new divergence here. Inverted VIX has made new highs above August last year, price has not. This bullish divergence is unresolved, and this supports the main Elliott wave count. However, this week between VVIX and VIX, VVIX has made new highs above October last year, VIX has not. With volatility of VIX elevated, this divergence is bearish for price for the short to mid-term. There is still, however, bullish divergence, which is unresolved between VIX and VVIX. So these two together are giving us really conflicting signals, almost cancelling each other out. And to be honest, the signals from this just haven't been that useful lately. I'm not going to give it much weight. On the daily chart between price and inverted VIX, here's that short to mid-term bearish divergence. That hasn't been resolved yet. For the very short term, for this week, price and inverted VIX have been moving pretty much in tandem. There's no new divergence here. But between VIX and VVIX, There is some very short-term bearish divergence. That would also suggest again that maybe minor wave 2 could move a little bit lower. So just be aware of that risk next week. That's it from me this week with your S&P analysis. I hope everyone's having a fabulous weekend.